Welcome back to Bunnex Investment Group. In this video, I'm going to teach you a strategy which consists of only one signal, and if you are consistent trading that particular signal, you'd find yourself having consistent returns. All right, so basically we need to understand the goal of the market makers, who are the enemies within this forex trading space. So market makers don't care about direction, they care about liquidity. All they need is traders on the wrong side of the market so that you can provide liquidity for their entries. Retail traders to enter early so that smart money can take the opposite sides, and then they stop hunt to engineer liquidity at those particular key zones. All right, so let's learn how to play around this in this particular video so that you can make money out of this particular arrangement. Firstly, this is what you're going to learn. We are going to talk of the indicators that are required, which I can provide you for free. You just say hi on Telegram, not on the YouTube comments, but on Telegram, so that I can provide you the full template. Then we will talk about the dealer's hand, then the shift flow, entry point, and then last but not least, market examples, right? So basically, we need to understand that to capture the right bias, there is need for us to use several time frames. By several time frames, we all know that whenever a bias is confirmed on the higher time frame, it will usually play out on the smaller time frames. So for this system, we'll actually use two time frames, which are basically the H4 and the H1 time frame. So the H4 will give us a bias, and the H1 will actually give us entry, right? So H4 is for bias, H1 is for entry. We all know that market makers loves to play their game on the higher time frame, not on the smaller time frames. So basically, these are the indicators that are required, and we use them not for them to predict where the market is moving, but for us to simplify the market view we will use. All right, so basically these are the indicators. The first one being the traders dynamic index, which is called the TDI in short, and then the moving averages, which are the 5, 13, 50, 200, and 800. Right? These are the moving averages that you require. So these are actually free indicators. And if you are someone who has purchased the recent released btmm Pro indicator, you won't need these particular EMAs. You just need this one and the btmm Pro, and you are done. Why? Because the btmm Pro will actually pinpoint an entry, and there will be no longer too many confirmations that are required. So the btmm Pro is actually going for $45 per month, but it is optional. All right, so basically, let's define the pattern. What do we need to see for us to make a move, or for us to start deciding to make an entry? All right, so the first step is to observe the TDI indicator on the H4 time frame. So this is how the TDI looks like for those who do not understand it or haven't used it. These blue lines are called the volatility bands. This yellow line is a moving average, as well as the red line, which is called the signal line. But the most important is this green line, which is an RSI line, and it shows us the relative strength of a currency in their pairing. So we need to see what we call a shark fin. A shark fin is basically when this green line pierced outside. You can see here it pierced outside the bands, and this is on the H4 time frame. So low bound shark fin, which is at this particular side of the 3DI, is equal to buy side for H1. If we see a low bound on the H4 time frame, like in this particular case, we will be waiting to buy on the H1 time frame. And high bound shark fin is equal to sell. If it's actually above in this particular region, we will be looking for sales on the H1 time frame. All right, so pattern position, after that has been issued on the H4 time frame, we mark, right? We mark, after observing the shark fin, one must mark the point on the chart as a peak formation high or peak formation low. So this is a mark on the H1 time frame after you've seen a shark fin on the upper bound of the H4 time frame. And after that, you can see there are these EMAs. The one in blue is the 50, the one in red is the 13. We need to see this H1 peak locking, and locking is basically meaning a crossing over of the 13 and the 50. Like in this particular case, it's in the downward side. And then after the peak locks, we will need to see a retracement to the 50 EMA. We can see that after the peak had logged, or this basically M pattern as a peak formation high had logged, we can see the market coming back to the 50 EMA for our possible entry. So this is where we'll take action. We actually want to take action at the first touch of the 50 EMA after the peak has been issued, like in this particular form. All right, before we dive into examples, I want to personally invite you to join my one-on-one mentorship program. If you are serious about turning your trading into a powerful and sustainable source of income, this is for you. Use the link in the description. I only take a few students on a first come, first served basis. So secure your seat right away. All right, so this is silver, which is silver against the dollar. And the first thing that I've already done is, you can see this is H4 time frame, and I've actually went to see on the TDI. You can see we had a shark fin here. We had another shark fin here, we had another shark fin. So I've already marked the shark fins so that it will be easier for us to go through for examples. So we said that's the first thing that you need to do, and then you switch to the H1 time frame. On the H1 time frame, all that we now require is basically to go through. We can see this is a peak formation low, and that peak formation low actually logged at this particular point. This was the lock, and we can see our entry was going to be on the first retest of the 50, which was this one. So we could make our buy entry right there. Right, let's go on. We can see this was another point where we had a peak formation low, and then the peak logged. After peak log, what did we expect? We expected to see the market to retest the 50, but in this particular case, it actually took long it retested. In this particular case, the candlestick reversal pattern was not issued at 50, and then we could have entered somewhere here, but it took long within the consolidation. Whilst doing so, it also gave us another peak formation low, and after that peak formation low, we can see that there was a peak lock at this particular point, and after that peak lock, there was an entry that was issued on the 50. So we can say we now have two entries in a row that are good entries or winning entries. One that is lost due to the fact maybe you were going to be frustrated and close it prematurely. So in this particular case, the market went to the upside like that. And let's go on for us to get another. We can see here it was actually a peak formation, and then it locked here. After locking, we can see that it gave a pullback to the 50, which is at this particular point, right? So this was another point of entry, and we can see the market going to the upside. Here we had a peak formation on the upside like that, and the peak actually has logged here, and after that peak has logged, we can now say, or we can now expect to see the market go to the downside. So here is actually a point of action where we are expecting to see the market drop, right? To see the market drop like that. This is how you would be trading using this particular trading strategy, and all that you need is to keep on doing the same thing over and over again without deviating from the rules. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.